Hey guys, it's Eric with Low VA Rates, wearing red. Happy Red Friday. Look down here and click that subscribe button. We want you to subscribe and follow us on YouTube. Today we're going to talk about two really important things, residual income and DTI, or debt to income ratio. And they're different. We're also going to talk about what they are. First of all, what are they? Well, it helps you figure out how much you can afford. Sorry, I'm trying to stay in the frame here. We want you to figure out how much you can afford. And these are two different ways to do it. First of all, let's talk about DTI, debt to income ratio. Simple math equation. You put your debts, okay, above your income. That's a division thing. I've got kids in school, if you do too, maybe you help them with your homework. So we just talked in a prior video, hopefully you saw that. We talked about figuring out what your gross income is and what your debts are. So let's just say you have about $2,000 a month in debt. And keep in mind, you got to take your mortgage payment and put that in here. So there's the mortgage debt, and then there's all your other debts that we've talked about. You take that, you divide it by your income, okay? Let's say you've got $4,000 in income. I'm going to do simple math today because I don't want to look dumb on camera. If you take $2,000 divided by 4,000, you get 50%, okay? That's a 50% debt to income ratio. Now we've talked about not exceeding 28 or 36 depending on what part of the debt to income ratio you're looking at. This is a little high. Now, we can go higher than this in some cases, but we need to be very careful. Whenever you have a high debt to income ratio, which is anything above about 36%, you're gonna wanna then do this next test that we're talking about, and that's the residual income test. I'm gonna erase this board so we can talk about residual income. So residual income is super unique to VA loans. I wish FHA and conventional and everybody else did it, and one day they might, because this residual income is what sets VA loans apart from all other loan types. It's an amazing calculation to help you determine if you can afford the house you're getting. So what you do first, as we've talked about in other videos, add up all your gross income. All right, we're just gonna say you make $5,000 in gross income. If you don't know what gross income is, we've got some great videos that talk about that. So you've got $5,000 in gross income, and then you wanna take out all of the withholdings from your paycheck. So that's where you pull your paycheck out of the desk drawer, wherever you keep it, or I guess nobody even has paychecks these days. It's all online. You go and you start taking out taxes that they withhold. You take out Medicare. You take out, I think these taxes are called FICA taxes. You take out Social Security. You take out all these nasty withholdings that we all wish we didn't have, and you've got your net income. So we're gonna keep simple math today. Let's just say all the people that have their hands in your paycheck, there's $4,000 left in net income. Remember that. Then what you do is you start taking out all of your other expenses. There's housing expenses like utilities. There is your taxes for the home that you're buying, or if you're refinancing the home that you owe. There's hazard insurance. That's fire insurance in case something happens to your house. You take out all of your expenses and you're left with, we're gonna keep simple math here today. Let's say you're left with $3,000 in residual income. Here's how I like to kind of sum all that up. After you get paid, all of this junk comes out. After you take care of all of your other expenses, what are you left with to like breathe and enjoy life and save for a rainy day? The higher this number, the better, okay? And the VA has a table, which we've talked about in other videos, where based on where you live in the country and your family size determines how much residual income you must have. So let's just say, for example, you have to have $1,000 in residual income. That's the chart. You have $2,000 over. Sorry, I'm bending way down here. This means, back to the person that had a 50% debt to income ratio, even though that's high, if you can come and show a lender that after everything's said and done, you've got $2,000 more in residual income than the VA requires, you're likely going to be able to afford the house and still be comfortable and not over purchase due to the fact that you've got such high residual income. Anyhow, thank you for watching. Please wear red every Friday. If you haven't already done it, subscribe below. And listen, we love that you guys watch us each Friday. We'll see you next week at the same time.